The Doomsday countdown for U.S. stocks has begun. The U.S. stock market has not yet entered a systemic collapse, but it has moved from a strong market with high valuations into a stage where the foundation remains solid, yet marginal pricing is becoming increasingly fragile. In other words, this is not the end of the world, but the countdown clock has begun to move. A real market collapse often does not begin with an earth-shattering news event. It usually begins with a very quiet process. Capital is still pushing stock prices higher, but fewer and fewer investors are willing to keep entering the market. The indexes still look stable, but the market's internal buying support is changing. The US stock market still has several important layers of support. The first is corporate earnings. As of July 24th, among the S&P 500 companies that had reported second quarter results, 86% posted earnings per share above market expectations, while overall earnings growth remains strong. This shows that U.S. corporate profits have not yet suffered a systemic collapse. The second is that rotation is still taking place within the market. From early June to late July, although the market cap-weighted S&P 500 declined somewhat, the equal-weighted S&P 500 instead rose by nearly 4%. During the same period, roughly two-thirds of S&P 500 constituents gained, and 8 of the 11 sectors advanced. This means capital is mainly leaving some highly valued technology stocks and rotating into healthcare, financials, small and mid-cap stocks, and other relatively lower valued sectors, rather than leaving the stock market altogether. The third layer of support comes from the credit market. As of July 28th, the U.S. high-yield bond credit spread was about 2.84%. Although it had widened somewhat, it remained relatively low. For now, the credit market has not signaled that the corporate financing system is about to lose control. Therefore, we cannot simply say that U.S. stocks are about to crash. But another set of numbers is telling us the market's margin for error is shrinking rapidly. On July 29th, the yield on the 10-year U.S. Treasury had risen to 4.67%, while the 30-year Treasury yield reached 5.20%. This means investors can now earn a fairly attractive nominal return simply by holding long-term U.S. Treasury bonds. Under these conditions, stocks must deliver stronger earnings growth, more stable cash flow, or more compelling expectations for the future in order to continue justifying current valuations. The problem is that the market's most expensive segment is concentrated precisely in AI companies and large technology companies that must keep proving their future growth. This is the most dangerous aspect of the U.S. stock market today. Earnings have not collapsed, but the cost of capital has already begun to put downward pressure on valuations. At the same time, U.S. equity funds have recorded net outflows for 2 consecutive weeks. In the week ending July 22nd, U.S. equity funds recorded net outflows of $7.34 billion, up from $4.18 billion in the previous week. Growth equity funds recorded net outflows of $8.55 billion. A change has emerged here that deserves very close attention. Capital is becoming more selective. In the past, investors feared missing the rally, so they bought the entire market. Now, investors are withdrawing from high valuation, high volatility, and crowded sectors, leaving only assets with greater earnings certainty, lower valuations, or stronger defensive qualities. This is the first stage of the Doomsday countdown. T-3, rotation, not a broad retreat. The characteristics of this stage are: technology stocks fall, while healthcare and financial stocks rise. Large index heavyweights weaken, but the equal-weighted index and small and mid-cap stocks can still absorb capital. The market begins to reduce risk, but it has not yet lost liquidity. I believe the U.S. stock market is currently broadly in this stage. The second stage is what we truly need to watch next. T-2, the index remains resilient, but marginal buyers begin to disappear. The most typical signs of this stage are: the index rises or remains at a high level, but trading volume keeps declining. The index reaches new highs, but fewer and fewer stocks are making new highs. Volume contracts when the market rises and expands when it falls. Equity funds continue to see outflows, but corporate buybacks, passive ETFs, and a small number of large index heavyweights still keep the index elevated. After strong earnings reports are released, share prices no longer rise and may even open higher before falling. This point must be emphasized. Every stock transaction has a buyer and a seller, so a decline in trading volume does not simply mean that all capital has left the market. The real danger is this: active capital is withdrawing, while mechanical buying is still maintaining the market's surface stability. This mechanical buying may come from corporate buybacks, fixed pension allocations, passive index flows, and passive hedging by options market makers. As long as these sources of buying continue, the index may remain at a high level. But once they are interrupted, the market will enter the third stage. T-1. Stocks, bonds, and credit markets begin to move in concert. The VIX has now risen to 20.66, showing that the market is pricing in more risk, but it has not yet broken through our warning threshold of 25. The truly dangerous signals are: the VIX breaks above 25 and continues rising toward 30. Stocks fall while U.S. Treasury prices fall at the same time. High-yield bond credit spreads widen rapidly. ETFs experienced net redemptions for several consecutive days. The equal-weighted index, small and mid-cap stocks, and financial stocks also begin to fall in catch-up moves. Even better-than-expected earnings reports still fail to push share prices higher. At this stage, the market is no longer experiencing sector rotation. Investors are beginning to reduce risk exposure systematically. The final stage is T=0. T=0, the last straw falls. I believe the last straw that could truly trigger a systemic correction in US stocks may not necessarily be one company's earnings report. It is more likely to be an inflation reading, a poor US Treasury auction, or a sudden surge in long-term interest rates. When the 10-year US Treasury yield continues to approach or even exceed 5%, real interest rates keep rising, and equity earnings expectations begin to be revised downward, the market will suddenly realize earnings growth can no longer cover the cost of capital. Therefore, the real doomsday is not the index falling below a particular moving average. It is the moment when the marginal buyers who had been absorbing supply suddenly stop buying. For ordinary investors, the most important thing now is not to guess the exact day on which US stocks will crash, nor is it to liquidate immediately or short the market blindly. Because earnings, the credit market, and market breadth are still providing support, shorting a market that still has buying support too early can also be very costly. What investors should truly do is reduce vulnerability, control leverage, and do not concentrate all positions in the same high valuation thesis. Distinguish between a technology stock correction and a market-wide liquidity crisis. Focus on whether long-term interest rates, the VIX, credit spreads, and market breadth deteriorate at the same time. Pay particular attention to one signal. After capital leaves technology stocks, does it continue flowing into other stocks, or does it leave the stock market altogether? As long as capital continues to rotate among sectors, the doomsday countdown may remain at T-3. But if the equal-weighted index weakens, credit spreads widen, the VIX breaks above 25, and stocks and US Treasuries fall together, then the last straw may truly have fallen. I have set up a last straw for US stocks risk warning system. Every day, it tracks long-term interest rates, real interest rates, the VIX, credit spreads, ETF flows, market breadth, earnings expectations, and signals of leverage position unwinding. It issues an alert only when at least two categories of risk move in concert, or when a clear systemic event occurs. To receive the complete setup instructions for this risk warning system, follow the account first, and then leave a comment, Doomsday Alarm. Doomsday Alarm. I will send the complete GPT alert setup instructions through the account's backend to viewers who follow the account and leave a comment. Finally, I would also like to ask everyone a question. What do you think will be the last straw that brings down US stocks? Long-term interest rates breaking above 5%, the AI earnings thesis being disproved, or a leverage event that no one is currently watching? Leave your judgment in the comments. The market's most dangerous moment is often not when everyone is discussing risk. It is when everyone believes that the capital supporting the stock market will never stop buying.